today I thought I'd just run through some of the key themes from reporting season, as well as go through some of the key picks in my coverage universe. Yeah, so the first one, and it won't be a surprise to everyone, but cost inflation is everywhere. Yeah, from raw materials to labor to transport and logistics, costs do remain elevated. Many companies such as Amcor, Brambles, Reliance were able to increase prices to mitigate the cost increases. But in general, they weren't enough to offset margins, with EBIT margin across our coverage universe on average falling by around 50 basis points. Secondly, supply chains do remain constrained, which is somewhat related to the high cost environment. Many companies are continuing to experience tight supply chains, which is causing shipping delays, extended lead times, and also raw materials shortages. A big reason for this has been due to the shortage of labour, with COVID, forcing people to either be off sick or having to self-isolate, and that's causing a lot of operational inefficiencies. Regarding the situation in Ukraine, it's really only Amcor and Brambles that have some kind of direct exposure. For Amcor, around 2% of its revenue is generated from Ukraine and Russia, while for Brambles, as Raluca said yesterday, the exposure is very small, with the revenue from Russia really only a few $1 million or so. Turning to the US, and hopefully you can see that slide, but despite operational challenges, the underlying demand environment in the US housing market remains strong, and this has been supported by comments from Reece and Reliance, as well as other companies such as Lowe's and Home Depot. And then looking domestically on the supermarkets, the key theme coming from Woolies and Coles results is that food inflation is starting to come through, and that's likely to accelerate over the next few months. On inflation, price inflation in general is good for the supermarkets because it does help with their revenue growth and does help offset some of those cost increases. But obviously, the major operators, they need to just be a bit careful with those, pulling the price lever potentially too hard, because it is a competitive environment, and consumers are savvy. And if they do pull the lever too hard, there is the risk of a loss of market share. So running through some of the key picks in my coverage universe. So on the large cap side, my preferred picks are Amcor, Wesfarmers and Coles, whereas in the mid to small caps, I still really like Reliance and PWH. In the short term, there are some operational risks, given the uncertain environment, but longer term, I think they'll all do pretty well, given that they are high quality businesses with a good earnings growth profile and very good management teams. So looking at Amcor a bit more closely, so the first half result was a little bit weaker than what we expected, and that was mainly due to ongoing supply chain constraints and higher raw materials costs. As a reminder, Amcor does fully pass on the movements in raw materials costs through to customers, but it does have a 3 to 6 month lag, and that can have an impact on margins in the short term. The key positive, however, is that underlying demand remains strong, and that FY22 earnings guidance was maintained. On top of that, Amcor did announce an extra $200 million buyback. On valuation, the stock's trading on about 14 times FY22 PE now, with the yield of over 4%. So I definitely think it continues to look attractive. What are the key risks and why has the stock been weak over the past few weeks? It has come off over the past few weeks, which I think could be due to a few factors. So firstly, FX, a weaker euro is negative for earnings translation to US dollars, given around 25% of Amcor's revenue is generated from Europe. Secondly, the higher oil price. So resin is a derivative of oil. And while the higher oil price hasn't impacted resin prices just yet, it is a potential headwind. But as I said before, Amcor does pass this cost through to customers with a lag. And then thirdly, the Russian-Ukraine exposure. And as I said before, it's only 2%. It's a very small, but there is obviously concerns that how the war could potentially impact the European economy going forward. So, putting it all together, I don't see any of these issues as being major or not being able to be managed, but it does create uncertainty, and I think just a few things to keep in mind, which could potentially influence the Amcor share price in the short term. Okay, moving to supermarkets, Woolies and Coles. So on Woolies, no real surprises with the result for Woolies, given that they did give a trading update in mid-December. But on Coles, I think everyone in the market was really surprised that the Coles result came in broadly in line with expectations. Everyone, including myself, was expecting a downgrade or at least a weak result, on the back of higher COVID costs, supply chain disruptions, and labour shortages, which is what Woolies called out at its December trading update. So the fact that Coles was able to manage these costs well, I think was a really, really good effort. As I mentioned before, food inflation is likely to accelerate over the next few months, which is generally positive for the supermarkets. But between Woolies and Coles, if consumers do become more price conscious, then I think Coles does have a slight advantage because it does have better price perception than Woolies. And it also has a bigger focus on own brand, which is at a lower price point and generally a better margin as well. In terms of valuation, Woolies is on about 30 times PE with a yield of about 2.5%. Coles is on about 23.5 times with a yield of about 3.5%. I think, to be honest, in this operating environment where it's quite volatile, I think both would be okay as stocks to buy. But given that they are very good businesses operating in consolidated industry structures, but in terms of preference, I do continue to prefer Coles over Woolies, mainly on the back of valuation. Wesfarmers, so the result was largely in line with expectations following the trading update in January. I thought Bunnings' result was really good, with EBIT down only 1%, following 36% growth in the PCP, in an environment where there was a lot of disruptions around lockdowns and store closures. The industrials businesses did well as well, whereas on the negative side, Kmart, Target and Officeworks were heavily impacted by those lockdowns in New South Wales and Victoria. The stock has obviously been weak over the past few months, which I think could be due to concerns around higher interest rates and the impact that could have on housing and retail. And also the higher oil prices also a headwind, given that does add to cost of living pressures and is generally negative for retail. Longer term, I think Wesfarmers, I think it's an exceptional company, with a very good management team. And if you look at Bunnings, Kmart and Officeworks, they're three of the best known brands in the country. And on top of that, and you obviously don't want to be benefiting from a disaster, but I'd expect Bunnings to at least have some kind of positive benefit from the recent floods on the East Coast. From the rebuild from the recent floods on the East Coast. Reliance, so I've mentioned this previously, but the stock has been weak over the past few months on the back of concerns around US home builders, in a rising interest rate environment. Reliance, rightly or wrongly, has been caught up in that negative sentiment due to its large exposure to the US market. And for me, the reason why I'm still comfortable with the ad rating is because the underlying fundamentals remain sound. It's got a very good balance sheet. The majority of its revenue, over 70%, is generated from repairs and maintenance, and that's a lot more defensive and stable than the home building market. Underlying demand remains strong, notwithstanding ongoing supply chain constraints. And the stock's now trading on about 14.5 times PE, which I think is really cheap for a high quality growth business, especially when you compare it to Reece, and Reece is trading about 34 times. And I don't necessarily think Reece is a better business than Reliance. In terms of key risks, I think, sentiment towards housing, will have an impact on the share price in the short term, as well as FX and also higher raw materials costs. But Reliance have been very successful in the past in passing those high raw materials costs onto customers. And then finally, PWH, and was definitely one of the standout results in my coverage universe during reporting season. The key standout for me was motorsports, with a lot of racing categories returning to a more traditional calendar this year. And also OEM and emerging technologies also had good growth. The stock's not cheap. It's on about 48 times PE. But I do think it is a really high quality business. It's got genuine competitive advantages and pricing power. And the fact that they're continuing to invest in staff and capacity, I think, is a really good indicator for the future pipeline of work over the next 3 to 5 years. There's also a potential near-term positive catalyst for the stock as well, with PWH in a really good position to win a large Australian defence contract. And that announcement is possible over the next few weeks. In terms of key risks, and just kind of something to keep an eye on, is the pound. So, that has been weak recently. So just keep an eye on that. But it will highly unlikely impact FY22 earnings because they have largely hedged the impact on the pound out to the end of June of this year. So, I might leave it there, Tom, but I'm happy to take any questions.